finally, we get some news out of Warren Buffett because it's been slim pickings for the last little while. It's kind of, he hasn't really been doing much in his portfolio.
No.
And Charlie Munger passes away and he puts out a 2-line statement. He hasn't done any media interviews. It's kind of like Warren Buffett's just been a bit MIA over the last kind of 6 months or so. But of course, that stopped whenever this was released a few days ago because we did get his shareholder letter. It was a good one, actually, Hamish. You're gonna enjoy reading it. I'm sure we'll go through the major points here. But yes, firstly, the whole first page of the letter is normally Warren Buffett talking about his results versus the S&P 500 and getting stuck in this way. That was in fact at the end this time because the first page was just a full tribute to Charlie Munger, which was really, really nice. So he spoke about a fair few things. I'm going to summarize the most important point here. He said, quote, "In reality, Charlie was the architect of the present Berkshire, and I acted as the general contractor to carry out the day-by-day construction of his vision. Charlie never sought to take credit for his role as creator, but instead let me take the bows and receive the accolades. In a way, his relationship with me was part older brother, part loving father. Even when he knew he was right, he gave me the reins, and when I blundered, he never reminded me of my mistake. In the physical world, great buildings are linked to their architect, while those who had poured the concrete or installed the windows are soon forgotten. Berkshire has become a great company. Though I have long been in charge of the construction crew, Charlie should forever be credited with being the architect." So
Interesting.
I think that's quite nice.
Yeah, in many ways, I mean, in many ways, Munger is a philosopher. Like he's really just a lot of people think of him or talk about him as like a thinker, right? Like he's someone who has these amazing philosophies, not just on investing but on life and business. So it is interesting to hear Buffett kind of describe him as the architect, as kind of the visionary of the way that they've done things at Berkshire.
He's got really good mental models, and once you've got those fundamental, rational, kind of anti-bias models in your head, then you can apply it to lots of different areas. And Charlie always said that he applied that to lots of different areas of his life, including investments, and of course it paid off very well because there's so much psychology behind being a good investor. So, and we know that it was Charlie that originally, when he teamed up with Warren, one of the first things he said to Warren is forget about these cigar butt companies. Like, stop doing that. Stop following this Ben Graham approach. You just got to pay a fair price for a great business and hold on to it for a long time. And that totally changed the way Buffett invested. And that's obviously the core fundamental investing principle that Berkshire was built off of, and it came from Charlie. So it's really nice that Buffett kind of took the time to give him that credit. Because I honestly don't think that Charlie gets enough credit for his work at Berkshire. He's always spoken about as Warren Buffett's right-hand man. He never gets to stand on his own 2 feet in the media. He's always Warren Buffett's buddy,
Of course, of course. I mean, if you ask anybody outside of finance, just everyday people, most people have heard of Warren Buffett, but most people probably haven't heard of Charlie Munger, which is mind-blowing for people who are like us, who are kind of in the space. Because we understand how much he's contributed to Berkshire and his own, investing success and his contribution to value investing broadly as just as a topic.
Yeah, definitely. So I thought that was a really nice one-page tribute. Then he gets, so Warren then gets into the actual contents of the letter, talking about, his investment strategy, Berkshire Hathaway itself. He spoke about quite a bit. So I wanted to start off firstly with just what Warren Buffett is talking about when it comes to his investment strategy and what he looks to do and is doing right now. And it's nothing that we haven't heard before, but it's good to go over. He says, quote, he's always looking for businesses that enjoy good economics that are fundamental and enduring, and they also hope that these favored businesses are run by able and trustworthy managers. So immediately covers off 2 of the 4 key pillars of his approach. The first one is finding a moat, and the second one is finding really good management. He says, quote, this combination of the 2 necessities I've described for acquiring businesses has for long been our goal in purchases, and for a while we had an abundance of candidates to evaluate. If I missed one, and I missed plenty, another always came along. But then this is where it gets really interesting, and I was quite interested to see him write this kind of passage. He says, quote, those days are long behind us. Size did us in. though increased competition for purchases was also a factor. He says, quote, "There remain only a handful of companies in this country capable of truly moving the needle at Berkshire, and they have been endlessly picked over by us and others. Some we can value, some we can't. And if we can, they have to be attractively priced," so bringing in that fourth key pillar of the valuation into the approach. "Outside the US, there are essentially no candidates that are meaningful options for capital deployment at Berkshire. All in all," get this, Hamish, "all in all, we have no possibility of eye-popping performance."
Like how often do you see a CEO of any company be that honest about the future prospects of the business? It's super refreshing. It's super rare. Because I mean, he's just laying out the reality of Berkshire's situation and the change in financial markets since he began. You know, Berkshire is massive. There's only so many businesses that they could invest in that are big enough to, as he said, move the needle. And certainly the efficiency of financial markets has changed a lot since they began, especially with things like the internet and the availability of information now. Publicly available information is so widespread. So
you can think about it as liquidity. The liquidity of the market has risen. Anyone can just quickly jump in and jump out, and mispricings don't last as long. They still do come up from time to time, and he talks about this in a minute. But you're exactly right, Hamish. I looked up some stats because I'm making a video on it. He said, I found Berkshire is the 7th largest company in the S&P 500, right? It has a market cap of $868 billion. Their stock portfolio alone is $350 billion, and they've got $167 billion of cash on the sidelines. So it's exactly what you're talking about. There's only so many companies that you can invest in that will move the needle, and invest in, remember, Buffett likes to be less than a 10% shareholder. So big enough that you can make a substantial multi-billion, even $10+ billion investment, and then still end up as less than a 10% shareholder. So, I mean, immediately, you need a business that's got a market cap of over 100 billion, and there's not that many businesses out there. I actually looked it up. There's only, I think, 90 or 92, roughly around there, depending on market caps at the current time. There's only 90-ish companies in the S&P 500 that have a market cap over $100 billion. And as Buffett said during that, he's combed over these businesses hundreds of times, as hundreds of others have as well. And finding those opportunities in those companies specifically is very hard.
Yeah. So, I mean, it makes sense. The bigger the company is, the more eyeballs there's going to be on that company. It's just the reality of financial markets. The bigger it gets, the more success a company has, the more people are going to be paying attention and coming up with an idea of what they think the company is worth. And more people participating just means that the price is more likely to be either closer to its value or even exceeding its value as people are kind of putting a higher value on the brand of that company and the endurance that company's had for multiple decades in that industry. So it just becomes very, very difficult to find anything at that size compared to when, if you're managing a couple $1 million or $100,000 or $10,000, pretty much the world's your oyster. You can have anything, right? You can invest in any company because you're only buying a few shares. Even companies that there might be literally no analysts looking at. So it's a completely different world.
Yeah. However, there are still opportunities that arise, Hamish, as you say, even for the big dogs like Warren Buffett. And he actually spoke about this a little bit more in the letter as well. So he says, occasionally markets and or the economy will cause stocks and bonds of some large and fundamentally good businesses to be strikingly mispriced. Indeed, markets can and will unpredictably seize up or even vanish, as they did for 4 months in 1914 and for a few days in 2021, 1914. I think that's referencing back when he first started investing. He made an early reference. If you believe that American investors are now more stable than in the past, think back to September 2008. Speed of communication and the wonders of technology facilitate instant worldwide paralysis, and we have come a long way since smoke signals. Such instant panics won't happen often, but they will happen. So, a little bit of a reminder that yes, generally speaking, Berkshire is such a big behemoth, they can't really do much. That's not to say that there won't be opportunities in the market. he basically saying there will always be some opportunities. We just have to stay patient for them.
Yeah, it's such an important and it's kind of a funny line, but it is very true that participants aren't any more emotionally stable than they have been in the past. Humans will always, as long as humans are making decisions in financial markets, there will always be swings of optimism and pessimism. And he's right. I mean, the internet provides, probably more efficiency in that there's more publicly available information, more people bidding prices closer to their what their true value should be. But it also means that panic and emotional driven news and speculation moves quick. And you can really see stocks be affected by an overwhelming shift in sentiment through news. You have like news outlets all talking about a company's poor earnings. You have YouTubers talking about it. It's all over Twitter. You get this real flurry of negativity or optimism, and you still see these big swings. In fact, we might even be seeing bigger swings from pessimism to optimism than we've seen in the past. So those opportunities, certainly still exist, and probably will always exist.
Yeah. He says, though the stock market is massively larger than it was in our early years, today's active participants are neither more emotionally stable nor better taught than when I was in school. For whatever reasons, markets now exhibit far more casino-like behavior than they did when I was young. The casino now resides in many homes and tempts the occupants daily. Yeah. So there you go. Okay. It's sad, but it's true. It's great, I guess, that the markets are more accessible than ever before, but accessibility to financial markets is only a positive if you've got the investing temperament that you need to not make rash decisions. I think that's what he's commenting on there. Yeah. There will always be opportunities, Hamish, because human psychology just does not change.
Nope.
All right, what else can we talk about? Oh, yeah, this is interesting. I mean, I've been yarning on this so much. I think both of us really have been yarning on this so much over the last 12 months that it was kind of, I don't know, it was kind of nice to see Buffett say this in his shareholder letter, because I was like, yes, finally, from the horse's mouth, he said it. And then that basically is... I kind of first was my mind was opened up to this idea by Monish Pabrai with his talk called "Circling the Wagons," which actually gave at Berkshire Hathaway at the Berkshire meeting this time-ish last year, where he was talking about all of Berkshire Hathaway really just comes down to 10 to 12 great investment decisions that Buffett just never sold. He made the investment decision, he held the stock, and to this day, he still holds it. And he's made hundreds and hundreds of investment decisions, right? And so many of them yield just mediocre or negative returns. But just by holding these 10 to 12 stocks, these 10 to 12 good ones for the long term, that's created the company that Berkshire is today, the amazing behemoth, like the company that's, that allows Buffett to say that he's made 20% returns every year since 1965. So... yeah. He spoke about that principle of just finding the good ones and holding the good ones as as his real investment strategy. And he used two examples. He used American Express and Coca-Cola. This is a long quote, but it's a really good one. So I'm going to read you the whole thing. So stick with me here. He says, American Express began operations in 1850 and Coca-Cola was launched in an Atlanta drugstore in 1886. Berkshire is not big on newcomers. Both companies tried expanding into unrelated areas over the years and both found little success in these attempts. In the past, but definitely not now, both these companies were even mismanaged. But each was hugely successful in its base business, reshaped here and there as conditions called for. And crucially, their products traveled. Both Coke and Amex became recognizable names worldwide, as did their core products. And the consumption of liquids and the need for unquestioned financial trust are timeless essentials in our world. During 2023, we did not buy or sell a share of either Amex or Coke, extending our own Rip Van Winkle slumber that has now lasted well over 2 decades. Both companies again rewarded our inaction last year by increasing their earnings and dividends. Indeed, our share of Amex earnings in 2023 considerably exceeded the $1.3 billion cost of our long-ago purchase. Both Amex and Coke will almost certainly increase their dividends in 2024, about 16% in the case of Amex, and we will most certainly leave our holdings untouched throughout the year. Could I create a better worldwide business than these two enjoy? As Bertie will tell you, no way. The lesson from Kolk and Amex: when you find a truly wonderful business, stick with it. Patience pays, and one wonderful business can offset the many mediocre decisions that are inevitable.
Yeah,
So
it's a fantastic quote.
it's a good one. That last line really sums it up, doesn't it? But it's true. I mean, Amex and Kolk, they bought it so long ago. And now, of course, the anecdote that people always say is like, now they earn an annual dividend from Kolk that's like larger than their original investment.
Yeah,
or something close to it.
It's very close. I think the total investment in Kolk was about $1 billion that he made over a number of years through the late 80s, and then I think it ended in 1991. And I believe today they pay him a dividend in the range of $700 to $800 million a year, which is a 70 to an 80% dividend yield on cost. Which is just absolutely astounding. So regardless of what the stock value actually does, obviously I think the stock's also up maybe close to 20 times in value since then as well. So he's made 20 times on his money, which isn't in of itself isn't an astounding return given, I mean it is. It is an astounding return, but over the length of time, I don't know what the compounded rate is, but it's nothing, it's not even close. It's not even above the Berkshire's average. But with the dividends that have been paid along the way, and the astounding yields now, it does pay to hold on to those great businesses that just produce a ton of cash every year. So it's interesting to hear him talk about that. Yep.
Thoughts on the general strategy of just holding on to the few key winners? I mean, personally, I'm glad that this has come up for me now, because now that I look back even on my own portfolio, I realized that that's also what's happened in my own portfolio.
Yeah.
Most of my investing success has just literally been down to 2 or 3 investments that I've made. Even though I'm no god, I make plenty of bad ones, but yeah, it's crazy.
Yeah, that's certainly true. And the way to think about it, I think, is, if you're invested in a good business that ends up having these amazing investment opportunities over time, you make one investment decision, and then it's like the company itself is doing all of the future investment decisions just within the business. Like the profits are coming in, and the management team is deciding where to deploy it. And if it's an incredible business, there'll be lots of opportunity for internal investments. So, which is exactly what you want. You can make one decision, and then you just hold that business, and rather than having to then go and invest the money somewhere else and continually make good decisions, you've just got this engine that continually makes decisions for you, basically. It does make sense. And it's certainly been true for my portfolio as well. It's been a couple of businesses that have driven all of the gains.
Yep, it's definitely the way to go. I'm pretty sold on that one. Okay, last 2 things I just wanted to very quickly cover. I spoke about 2 investments in detail: Occidental Petroleum and the Japanese trading houses. He didn't go into huge specifics. He said at year-end, Berkshire owned 27.8% of Occidental Petroleum's common shares and also owned warrants that, for more than 5 years, give us the option to materially increase our ownership at a fixed price. Though we very much like our ownership as well as the option, Berkshire has no interest in purchasing or managing Occidental. So I don't think they're going to do some sort of big takeover. He didn't really talk about the business of Occidental so much, more just generally about the US oil industry, saying not so long ago the US was woefully dependent on foreign oil and carbon capture had no meaningful constituency. Indeed, in 1975, US production was 8 million barrels of oil equivalent per day, a level far short of the country's needs. But he's very excited that since that time, America has really created its own big oil industry, he says. And then, hallelujah, shale economics became feasible in 2011, and our energy dependency ended. Now US production is more than 13 million barrels of oil equivalent per day, and OPEC no longer has the upper hand. Occidental itself has annual US oil production that each year comes close to matching the entire inventory of the Strategic Petroleum Reserve. Our country would be very, very nervous today if domestic production had remained at 5 million barrels of oil equivalent per day, and it found itself hugely dependent on non-US sources. At that level, the SPR would have been emptied within months if foreign oil became unavailable. So less about Occidental specifically, more just about he likes backing the US oil industry in general.
Interesting.
Any comments on that, or should we move on to the Japanese trading houses?
Not really, except that, certainly an economic pain point for a lot of countries is being dependent on foreign oil. So it's interesting to hear him talk about that. I was just looking at India, actually, and whenever they're a massive importer of oil. So when there's been oil spikes, supply shocks in the past, they've been very exposed to those. So that's my comment on that.
Yeah, nice. And then just quickly on the Japanese trading houses, says Berkshire continues to hold its passive and long-term interest in 5 very large Japanese companies, each which operates in a highly diversified manner, somewhat similar to the way Berkshire itself is run. Berkshire has financed most of its Japanese position with proceeds from 1.3 trillion yen of bonds. This debt has been very well received in Japan, and I believe Berkshire has more yen-denominated debt outstanding than any other American company. The weakened yen has produced a year-end gain for Berkshire of 1.9 billion, a sum that, pursuant to GAAP rules, has periodically been recognized in income over the 2020 to 2023 period. Since we began our Japanese purchases, each of the 5 has reduced its number of outstanding shares at attractive prices. Meanwhile, the managements of all 5 companies have been far less aggressive about their own compensation than is typical in the United States. Note as well that each of the 5 is applying only about 1/3 of its earnings to dividends. The large sums the 5 retain are used both to build their many businesses and, to a lesser degree, repurchase shares. Like Berkshire, the 5 companies are reluctant to issue shares. So I think that's basically Warren just, we're in this for the long term. We did our little trickery with the yen-denominated bonds. We made a good investment. They're doing the right things. We like the people. Buy back a few shares. And I think they've made a hell of a lot of money on this investment already, and they haven't even held it for that long. So they're doing pretty well. But there's a bit of an update.
Yep.
But that is all I have from Warren Buffett's shareholder letter. There was a little bit more in there, but I will direct you to the letter itself if you guys want to check it out. So it's a good read.
Fantastic. Yeah.